Every year, insurance companies process billions of medical claims that determine whether hospitals get paid and whether patients are protected from devastating bills. On paper, the process looks simple, structured, and efficient, designed to move money quickly through the healthcare system. But behind the scenes, many payments that should take days are delayed for weeks, months, or even 90 days. Hospitals often perform procedures, submit claims, and wait patiently for reimbursement that never arrives on time. Doctors continue treating patients while their billing departments watch unpaid claims pile up in digital queues. And during that waiting period, billions of dollars quietly sit inside insurance companies instead of flowing back to the healthcare providers who already delivered the care. Yet the delays are rarely explained clearly to patients or doctors. Instead, they appear as vague messages inside billing systems, labeled as processing, review, or pending documentation. But within the healthcare industry, many insiders believe these waiting periods are not just administrative delays, but part of a financial strategy. To understand why these delays exist, it helps to first understand how medical claims are supposed to work. When a patient receives treatment, the hospital generates a claim that includes procedure codes, diagnosis codes, and itemized charges. That claim is electronically submitted to the patient's insurance company for review and payment. In theory, insurance companies verify the information, confirm that the treatment is covered, and then reimburse the hospital according to their negotiated contract. The process is highly automated and supported by advanced software systems capable of reviewing thousands of claims every hour. In many cases, the technical ability to approve and pay a claim exists within minutes. In fact, electronic claim systems were originally designed to speed up healthcare payments dramatically. Decades ago, paper claims could take months to process, but modern digital systems were supposed to reduce that time to just a few days. Yet in many hospitals today, payment delays remain common. One hospital finance executive once described the system as fast technology slowed down by deliberate friction. The software moves quickly, but the approval process often does not. And that friction creates a powerful financial advantage for insurance companies. Consider what happens the moment a hospital submits a claim. The treatment has already been delivered, the doctor has already been paid for their time, and the hospital has already spent money on staff, equipment, and medication. But until the insurance company pays the claim, the hospital carries the financial burden. For large hospitals, that burden can mean tens or hundreds of millions of dollars in unpaid claims at any given moment. For smaller clinics, even a short delay can create serious cash flow problems. And those delays often begin with something that looks harmless inside the claim system. One of the most common delay tactics is called a request for additional documentation. After receiving the claim, the insurer asks the hospital to submit more records to justify the treatment. That request can pause the claim for weeks while billing teams gather paperwork and respond. Another tactic involves what insurers call medical necessity review. Even when a procedure is covered under a patient's plan, the insurer may review whether the treatment was truly necessary. During that review period, the payment clock effectively stops. Then there are coding audits, which examine whether the hospital used the correct billing codes for the treatment provided. Coding errors do happen in healthcare billing, but these audits can also be triggered automatically by algorithms designed to flag claims for deeper review. Each flagged claim means more time before payment is released. From the insurer's perspective, these reviews are framed as safeguards against fraud and unnecessary treatment. But critics argue that the system often casts a much wider net than needed. As a result, even clean and valid claims can become trapped in long processing cycles. Some delays happen because claims are denied for small technical reasons that require resubmission. A single missing modifier code, an incomplete form, or a minor documentation issue can trigger a rejection. When the hospital corrects the problem and resubmits the claim, the processing timeline resets. This reset mechanism can stretch a payment cycle from weeks into months. Billing departments sometimes resubmit the same claim multiple times before receiving reimbursement. And every time that happens, the waiting period grows longer. Behind these administrative steps is a simple financial reality. Insurance companies hold enormous amounts of money while claims are pending. During those waiting periods, that money remains inside the insurer's financial accounts. When large insurance companies invest those funds while they wait to pay providers, Even short delays across millions of claims can generate significant investment income. In financial terms, delaying payment creates what economists call float, the temporary use of money that technically belongs to someone else. In industries like banking and insurance, float can be extremely valuable. When billions of dollars are held temporarily before being paid out, even a small return on that money becomes meaningful. And healthcare insurers process a staggering volume of claims every single day. According to industry data, major U.S. health insurers process billions of claims annually across hospitals, clinics, pharmacies, and laboratories. Each claim represents a financial transaction moving through a massive reimbursement system, and each delayed claim increases the amount of money insurers hold temporarily. Hospitals understand this dynamic well because their financial departments track payment delays carefully. Many hospitals calculate what is known as days in accounts receivable, a metric that measures how long it takes to receive payment after submitting a claim. When that number rises, hospital cash flow becomes more strained. Some healthcare systems employ entire teams dedicated solely to chasing delayed payments. These specialists monitor aging claims, contact insurers repeatedly, and escalate cases when payments stall. Their job exists because the claims process rarely moves smoothly. Billing specialists sometimes describe their work as a constant negotiation with insurance companies. Every delayed claim becomes a small battle over documentation, codes, and contract rules. And while those battles continue, hospitals wait. For smaller physician practices, the impact can be even more severe. Unlike large hospitals, many clinics operate with limited financial reserves. Delayed insurance payments can threaten their ability to pay staff salaries or purchase medical supplies. Some doctors report waiting months to be reimbursed for procedures they performed long ago. During that time, they continue treating patients while their previous work remains unpaid. The financial stress of those delays has contributed to growing frustration among healthcare providers. Insurance companies, however, argue that delays are often necessary to ensure accuracy and prevent overbilling. The healthcare billing system is complex, with thousands of procedure codes and constantly changing regulations. Insurers say careful review protects patients and keeps healthcare costs under control. Yet critics point out that many claims delayed for months are eventually approved and paid in full. That outcome raises an uncomfortable question within the healthcare industry. If the claim was valid all along, why did it take so long to pay? Some experts believe the answer lies in the scale of the healthcare economy itself. Healthcare spending in the United States alone reaches trillions of dollars every year. When an industry moves that much money, even small timing differences can produce massive financial advantages. A delay of 30, 60, or 90 days across billions of dollars in claims can create a huge pool of temporary capital. For insurers managing those funds, the incentive to slow the flow of payments may quietly exist inside the system. And because the delays are spread across millions of transactions, they rarely attract public attention. Hospitals and providers have developed strategies to fight back against prolonged payment delays. One method involves escalating claims through specialized appeals processes. When a claim stalls too long, providers can formally challenge the delay. These appeals trigger higher-level reviews inside the insurance company. In some cases, the claim moves from automated systems to human reviewers with authority to approve payment. That escalation often speeds up the process dramatically. Healthcare organizations also rely on contract enforcement teams that monitor whether insurers follow the payment timelines agreed upon in their contracts. Many insurance agreements include rules requiring payment within specific timeframes. When insurers violate those timelines, providers can file complaints or demand penalties. Some hospitals now use advanced analytics to track payment patterns across different insurers. By analyzing thousands of claims, they can identify which companies delay payments most often. That information helps hospitals prioritize which claims require aggressive follow-up. There are also external watchdog groups and regulators who monitor insurance payment practices. State insurance departments sometimes investigate patterns of excessive claim delays. In extreme cases, insurers can face fines or legal action for violating prompt payment laws. Despite these oversight mechanisms, delays remain a routine part of the healthcare billing landscape. Many providers accept them as an unavoidable cost of doing business with insurance companies. The system continues operating even as frustration grows on both sides. For patients, the hidden delays can create confusion and anxiety. When insurers postpone payments, hospitals may send bills directly to patients while the claim remains unresolved. That can make patients believe they owe money that insurance will eventually cover. Some patients receive large medical bills months after treatment simply because the insurance claim has not finished processing. During that time, the hospital waits for payment while the patient waits for answers. The financial uncertainty spreads through every part of the system. In the end, the 90-day waiting period is rarely just about paperwork. It reflects a complex financial ecosystem where timing, cash flow, and billions of dollars intersect. What appears to be a slow administrative process can quietly serve powerful economic incentives. The healthcare system is often described as one of the most complex financial machines in the world. Hospitals provide the care, insurers control the payments, and patients sit in the middle trying to understand the bills. And somewhere within that machinery, time itself becomes a financial tool. Because when money moves slowly through a system this large, someone benefits from the delay. The question is not whether the claims will eventually be paid. The deeper question is who profits while everyone else waits. If you found this investigation helpful, consider liking the video and subscribing to the Medical Money Machine for more deep dives into the business behind healthcare. Your support helps expose how the system really works behind the scenes. And let me know in the comments what part of the healthcare system you want us to investigate next.